just kind of talking, Geof, about how this week we've got a lot of news. It's jam-packed. We've got PPI, CPI, and consumer sentiment Wednesday, Thursday, and Friday. And we had that just terrible jobs read on Friday. It was really bad.
Yeah, I mean, uh, it
It's tough.
was in a way. I'll agree with that, but I mean, just from if you just kind of look across everything that where the jobs are coming from, 16,000 was from the government, um, and I think the big industries out there right now that are really getting whacked because of for, forgive me if I'm wrong, the big beautiful bill. Is that what they're calling this thing?
The big
Um,
beautiful bill. Yeah.
yeah, that thing basically cut the subsidies into the wind and solar stuff. And I mean, you look at what's that company, Mosaic? They're going bankrupt. There's a couple of those now going bankrupt just because, well, they don't get their subsidies and stuff like that anymore, and they can't make money. In fact, I think Mosaic laid off half of its workforce a couple weeks ago, and now they filed for bankruptcy. So I think you're
Wow.
seeing a lot of that happening. I think the
Yeah.
energy industry is kind of where a lot of this is going on. Even out in California, they're shutting down refineries and stuff like that. Oh, in fact, the
Yeah.
Phillips 66 refinery is that's going to be like 700, 800 jobs right there. There's a Valero one that's going to be shutting down, at the beginning of next year. So I think you're going to see a lot of that kind of happening, in that energy industry and kind of
Hmm.
go from there. But be interesting to kind of see how it all pans out. I don't know how things are going to go up. Not only that, but I think even the small businesses, they're not hiring right now. I
Yeah.
mean, just because of the economy, and I think there's still a lot of uncertainty. If you even look at how insurance companies that actually insure those energy companies and stuff like that, they're actually jacking their insurance rates up and
Really.
they're shortening the term of that policy. They used to get 3-year policies. Now they're going down to a 1-year policy so they can keep raising rates and everything like that. So, I mean, and
Absolutely.
they actually put into their formula, that's what, all of them. I mean, if you go get a loan or if you go get insurance, something like that, they have this, I'm going to just call it AI now.
Yeah.
That they'll put all your information in, and it'll spit out, hey, based off of what's going on, this is going to be the rate. And they're actually putting in political influences in that now. So,
Really.
and if
What
they're
are we talking
doing that,
about?
what's that?
What are we talking about?
Insurance.
The what political? What is that?
They're putting political influence into insurance now, to get a rate because it's just like if you put tariffs in there, well, AI is going to say tariffs are bad, so that's going to make you at more risk, and therefore your insurance premium is going to be higher because you're getting influenced by tariffs and stuff like that. I mean, that's the thing.
That's
I mean,
crazy.
that it's crazy, but they've just started doing this, and so now they've taken the terms from 3 years to 1 year on a lot of the companies and everything like that, and that's going to be a higher cost for them. And so not only that, but every year they can raise it and raise it and raise it just like they always do, right? They always screw everybody. So
That is
it's crazy. It's dumb.
that
It
But
is
is.
that's what
Absolutely.
they're doing. And I mean, I don't know. They're a private company, so I guess they can
who,
do what they want to
who is
do
Sure
this?
can.
unless they're going to get regulated somehow.
Who is
So,
this?
what's that?
What company is this?
Well, I mean, like you look at companies like Mosaic just don't file for bankruptcy, right? So, but a lot of those solar and wind companies are really getting hammered. Not only did the big beautiful bill don't cut all their subsidies and all that and the funding behind it, but now insurance is so high on them. And what was really interesting when I was reading this weekend was if you have wind and solar, or wind power out in the Gulf or off of the coast or something like that, they don't want to insure it at all just because of hurricanes and everything like that. So they're just like, you're on your own. Go for it. It's just like, oh my
Good
God, you
luck.
need to build now. You don't have
What
any
happens if a
insurance.
wind? What happens if a wind turbine goes down? You need some insurance for that puppy.
Yeah, exactly.
Absolutely.
And those things aren't cheap.
Can't go pick those up at Dollar General.
No.
Unfortunately not. If only.
Uh,
I'd put one on my roof. See how much
Yeah.
energy I could generate then.
I know. Yeah, it gets kind of windy in the DC area in the spring.
There you go.
well,
Well, so we
What's
got
up?
Chris with us
What's
now.
up,
What's going on,
Chris?
Chris?
What's happening, fellas? No,
How's
say,
everyone's weekend?
weekend was good, man.
it was
It was
real good.
busy and a blur as it typically always is.
Nice, nice.
But yeah, I came into the markets today with some fresh highs for the year, so that was pretty nice. Blake and I actually talked about that a little bit on Saturday. So even though the market's down off the highs slightly, I still think this correction we still have to have. Obviously had some pretty rough jobs numbers on Friday. I think this week with inflation numbers, you're going to see stagflation headlines all over the place, whether the market cares or not. I'm telling everyone to write one level down in the SPX this week, 6360. If we take out that low, then it's correction time, and we'll probably see maybe 5% correction. Maybe if it gets a little nastier, maybe 10% correction. But if we don't take out 6360, this market has yet to care. I wanted to ask you guys about yields right now. 10-year yields are dropping. So if you got the screen there, Alex, you go US 10Y. I find it very interesting that we've got 4 to 5 days in a row that the 10-year yields are dropping. But look back to what happened in August, September of 2024. The same thing happened with the markets where they were kind of leading the decline in the 10-year, and then as soon as the Fed cut, the yield started to rally again. So I wonder if we have something similar to that taking place this go around with the Fed looking to cut in September, maybe again in October or December. But the markets are trying to price in about 6 cuts until the end of 2026.
I just wonder
So
why they would be leading that. Like if
I don't know. I don't
if
know
we are
why.
heading towards a recession.
Probably to pivot. Honestly, I feel like they're gonna. I think if the 10 years are dropping, I feel like that's a weird rip in TLT. I honestly kind of want to get out all my TLT positions right now. I've got about 20. I'm trying to think. If I close out for 23, so 23 out of 24, I've got about 95% of my profit right now in TLT, which isn't bad.
So are the 2 and the 5s doing the same thing?
Let me check.
Let's look. Every question will be answered on Profit Panel, folks. Yeah, they are.
Okay.
The 5 USO 5-year USO 5. Type it 0. Is it 0? 0 5. Yep.
Yeah, they're all doing it.
Both down.
Yep.
So, yeah, I
mean,
just I haven't seen the bond market step out of line like that all year. So, I mean, having that big rip since the basis trade during Liberation Day, now that TLT is up so aggressively, the dollar, by the way, hasn't done anything. DXY is nowhere to be found as far as movement, but TLT, that's a big move. I wonder if that's a setup that's going to ultimately be a fade trade on the bonds. Yields rally again, bonds dip, but we have a nice little squeeze and relief rally beforehand. So I don't know. I think the smart thing for me is just to get out of these TLT trades.
Well, what's interesting is today, this morning actually, I had 2 trades from my flow scanner I wanted to send people. I ended up sending them a different one, iron. But this one showed up TLT, and but I wasn't. It would have been a nice little trade. I wasn't, but yeah, I was like, this is weird.
Yeah.
This is weird. I don't really want to. I mean, we gapped up and then we gapped up. It's like, I don't really think that's going to keep on going up today, but lo and behold, it sure did. So that would have been actually a really, really good trade too. But
we're above the 200 period moving average right now, and we haven't been above that since literally the basis trade broke in April. So I just feel like this is another like run up, melt up. I would not be surprised if by this week or next week we're backfilling some of these gaps that TLT just had these last couple of days. That's a lot. That's a lot of direction out of nowhere.
It's pretty wild. I mean, look at that band we were in, and then boom.
Yep. So that's almost a 5% move in 4 trading days. That's
well, my question is the economy about to get? Are we about to print some bad numbers? Are the bond markets? Are they running? Are they front running some bad prints? Some bad.
That's very true.
Data?
That's true. Well, that's what I'm saying. Stagflation is probably going to be the headline we keep reading about. Why? Because we have one of the worst jobs, prints, and trends that we've seen for like the last 4 or 5 years.
Yeah,
companies aren't firing people yet. but they're not hiring. Nobody's hiring. It's like healthcare only, services only. Tech
Right.
clearly isn't hiring. We have, we've basically throttled back immigration. So, I mean, our labor market numbers are showing like, the uptick in unemployment percentages are still pretty low, but it did go up to 4.3. We had an embarrassing job number forecast for 73. I think it came in 22. Revisions put us in the negative. So we've lost like 200 some thousand jobs over the last like 5 or 6 months. So
Yeah,
it's some of the worst trends we've seen in the last like 5 years.
Bodine has an interesting take. Is it due to expectation of rate cut that they're chasing bonds that much? Are people trying to get in before they? But like the thing is just because the rate, I mean, we saw this happen. The rate cut. I mean, the Fed cut the rates and the bonds went up. So I mean, it's not like just because the Fed makes a decision doesn't mean the bond market has to agree or even coincide or work
Yeah, I was
go
gonna
in
say
tandem with
the
that
Fed
decision.
funds rate's just an overnight rate, but
Yeah.
the bond market is actually, if you got risk in the market, or do you not have risk in the market? And that's based off of, the treasuries or mortgages or municipalities, whatever you want to look at. But it's more of a risk factor more than anything. So right now they're saying there's less risk and therefore rates are coming down. But is that real?
Is that? I mean,
Yeah.
is that? I mean,
That's the question.
Yes, that's true, but less risk. There's because they
Right.
go down in a recession, which would be more risk, you would think, right?
Yeah, and that's my point is I'm with Chris. I think this is buy the rumor, sell the news kind of thing. It's going to rally up into the Fed, and after the Fed cuts, they'll bring those right back down again.
That's the timing that I'm thinking of, is like if I don't do anything right now, I think that this maybe still continues this little melt up until we see the Fed cut. So I'm thinking I might just want to let things marinate this week and see if the TLT can hang on to these levels. I do have a sell call on my diagonal that is out to the end of this month, and it's at 89. So we're already above that. Right now, my trade is, so my max credit would be $24. There is a chance, because my long call is out until 2027. I technically could have my long call exceed the max credit because I'm still long that call. But right now it's trading for.
Which ticker is this?
This is for TLT. But right now the trade itself is trading for $23.15. I mean, if my max credit's 24, I get out 85 cents off of that. That's still a pretty good trade. I mean, I'm up as a collective portfolio run. TLT is up around $12,600. I certainly don't want to give it back, and that's also liquidity in contracts that I'd rather put elsewhere. The problem was my grand plan was get out of TLT, position it in gold and silver, but gold's already making a run. We're at all-time highs. I really don't want to do just jumping into gold. What I want to do is sell more puts on gold, and same thing on silver, sell more puts. I don't really want to buy the highs. Woo! I want to position for them. Yeah, it just keeps going, man.
Gosh darn it. That's great.
That's great.
That train has left the station.
Yeah, seriously, man.
That's what I'm saying. Sell puts though. Like I'm selling lots of puts at 280, 285, 270, 275. I'm like, gold would have to pull back 15 to 20%, and then I'm still maybe taking some assignment there. But we also could run up into spot price at 4,000, and I just keep melting up with the shares that I have. But I haven't taken GLD shares off yet. I just have some puts for protection. That's it.
Yeah, well, we were talking about that. I remember 4,000 being that target last week, Geof. That I mean, we're just since when we talked, was it Friday? We made a big move towards that goal. About a fifth of the way there in just one day.
Oh yeah, I mean, the one thing that of course, I'm long gold futures. I bought it last week, but I'm looking for 2,700 to get out. But I think my big worry right now, and I've said this a million times, they can't get above 42 on silver. I mean, flat out, they can't get above 42. And until they close above that 42, they keep hitting it and backing up, hitting it and backing up. You see it right there.
Yeah.
And if they can get above silver and close above that thing, then I think we get to continue to move up. But until then, I'm a little bit suspect about gold's little rally here. And it might be the same thing that we're looking at. We hit Fed day. Maybe they give that as a correction, coming back down with bonds.
When's that? 21st, right?
Fed day is the 17th.
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 Yep.
That's a week.
Next Wednesday.
Yeah.
Oh snap! For some reason I thought it was after. So we got Fed and then
No, man, we
options.
got big stuff, dude. It's PPI, CPI this week, Fed next
Yeah.
Wednesday. It's like there's a lot of stuff that can happen. And coming off of weaker job numbers, look, if there's any time to have the market respond to a little downtick, this is probably the window. I mean, we have bum inflation. We're probably going to print higher inflation. Just even if it's as forecasted, both PPI and CPI forecasting higher prints. I'm telling you, all you're going to see is it's going to be stagflation headlines.
You got retail sales next week too now.
Yeah, I'm closing out TLT. I've got a max credit of 24. I'm closing out for 23.10. I'm just gonna dump it. I'm gonna get some buying power back, and yeah, I'm good with the. That's a good trade. I mean, I still made like my max profit would be about 20 grand. I'm taking 12.5, 12.6 out of it, so it's not fantastic. But I'm also not going to wait until the end of the month and hope that TLT is still above 89 when it very well could give back everything we just saw in these last 3 days. So
Yeah,
I'm taking it off the table now.
with all those events coming up. It's a little risky.
Exactly.
Man, if we do make it through September and the market shrugs us off, we should be good.
Well, I think that the market, I mean, do you have any key levels, guys? Like, I think the market needs to stay above 6,000 for this to remain resilient. I think if we dump aggressively below 6,000, I'm a little concerned that this market is going to face some deleveraging. I've got, I was looking at some currency trades today. I did some like, top down analysis stuff. I don't know if you guys follow the Japanese yen closely or not. I mean, I'm watching Swiss yen, dollar yen, euro yen. Look, right now, the Japanese yen or the Bank of Japan is the only central bank that's probably going to be raising rates in the next 12 to 24 months. And at some point, they tend to be in these cycles where they're going to be forcing like the carry trade unwind.
Yeah.
And if we see an unwind in the carry trade, you're going to see some major risk off trading.
Well, especially if we cut rates.
That's what I'm saying. It's like,
Yeah,
and like this whole thing has been the Fed says we're going to cut, but we haven't touched anything for almost a year. It's like we cut last year. We're not touching it again for another year. It's like we get a lot of free mileage out of what we say, but we don't do anything. And so now that they start to cut, if we cut by 150 basis points and bring our official cash rate down to like, low threes or sub 3, and all of a sudden the BOJ is up to 1%, that makes the carry trade like non-existent. And I just wonder what that looks like in the FX world.
Yeah, well, 10 years basically. It's been like 10 years. The carry trade's basically been fluffing up the markets.
2022, man. That's when the whole thing started, back in 2020 or 2012.
Did it only start that recently? I thought it'd been going on for longer.
Well, the heavy manipulation. I mean, my Forex career started like 07. So 2012 was, oh my gosh, this is the wildest thing I've ever seen. And then there was an unraveling during COVID in 2018 and 2022. So there's been 4 or 5 phases of like, QT to QE to radical monetary policy.
Yeah.
I mean, when 2022, the dollar yen broke from 120 up to 150 and then up to 160. I mean, I look back on a chart that went back to like 1970. I'm like, dude, we can go to like 200 on the dollar yen. So like calling a top or a bottom on the yen is sometimes the most terrible trade. But my trade is
what the yen carry trade is to folks, because it's pretty important to at least understand the basics of it.
Yeah, the basics are this. I mean, if you think about what yields offer, so right now our cash rate is 4.25%. For a decade, the Bank of Japan was at negative 0.1%. Negative. So what people were doing is taking out debt in Japanese yen and getting, rather than putting money into the Japanese yen or the Japanese banking system, they're borrowing money at like super cheap rates, like basically zero. And you're putting it anywhere in the world and making money on it. So it was like the global arbitrage of you can borrow in yen and put it anywhere else and make money on your investment or make money on your loan. And so this is why the market also had suppressed volatility. This is why we saw like this melt up overall in the stock market. This is why people were taking excessive amounts of risk. And, COVID wasn't really a deleveraging event. COVID was just oh my gosh, the whole world's going to shut down. 2022 was the deleveraging event. If you want to look at, Geof, do you have or Alex, you have yeah, that's fine. Dollar yen or JPY USD doesn't matter. Anytime you see those big runs, so that 2024 run.
Yeah, look at this. So
that was summer of last year when everyone thought, oh my gosh, the carry trade is going to unravel.
And this is when the market sold off too. So
that was a 10% correction.
It does have real ramifications for U.S. equities.
Absolutely, it does. Here, can you just switch that around? Go USD JPY.
Yeah.
And go to a weekly chart. I really don't want to see this trade happen, but I want it to be on our radar because this is a great currency trade if you can see, I see a head and shoulders there at the top. You see a neckline right around the 140 handle. Just draw a horizontal line at 140. If that neckline breaks, you're going to see the dollar yen fall to 120. That's a 2,000 pip trade, and that is a massive deleveraging and de-escalation of risk in the markets. So I don't want to see that trade happen, because I feel like if that happens, you're probably going to see the equities market sell off 10, 15, 20%.
Yeah.
So I'd rather see slow grind, slow grind, slow grind, slow grind. Maybe we go back to 160, 162, and then maybe we fall back to 140, and maybe it's a multi-year range. But if we break 140, I hate to say it, but that pattern coming to like fruition is a 120 measure move. So
I mean, that'd be crazy. Dinosaur Skip can't show you what the dong looks like. This is a PG-13 show. Sorry.
you talking about is that Thai or Vietnam? You're talking Vietnam?
Yeah.
Sure, it's a
I don't
Vietnamese
know.
dong.
I get the dong. Yeah, Vietnamese dong is
Yeah.
the, but that doesn't really matter, right? Who cares about the dong? I've
Yeah.
never
Well,
thought.
I mean, I'm saying that because there's a lot of, I mean, there's a lot of debt, there's a lot of leverage in Japanese yen currency, and it's always been this like really intense safe haven flows tend to go right back to the Japanese yen. It is the most challenging currency pair to trade, in my opinion. I've traded currencies since 07 through the great financial crisis, through freaking Brexit and crashes and all sorts of stuff. The Japanese yen doesn't behave like a technical FX pair. The Japanese yen becomes fundamentally driven and irrational. And so instead of having, everyone likes currencies and everyone likes to use Fibonacci's and expect pullbacks and pockets and pivots and efficiencies, the Japanese yen, when it gets in these phases, it doesn't obey any of that stuff. It'll go 2,000 to 3,000 pips and never pull back. It'll go like 2012, Japanese yen pairs went like 4,000 to 7,000 pips without any pullbacks.
That's correct.
Like it literally went push, pause, push, pause, push, pause for 6,000 pips. If you have one standard lot in that trade, that's making you like $6,000, or I'm sorry, 60 grand in that move on one standard lot.
Was this 2012?
2012.
Yeah.
And I mean, I know a trader that had a $10 million fund that lost all of it because he was trying to buy the pound yen during the great financial crisis. He lost the whole thing because it went down, I think, 8,000 pips in like 12 months, and it never pulled back. So again, it's like it is I mean, a lot of people call like natural gas widowmaker in the commodity space because it's such a hard one to trade, and we've been 2-3 year drawdowns and bear markets. The Japanese yen, if you're a currency trader, you're either killing it on the right side of those trades and trading what you see, or you're getting murdered trying to dollar cost average into the Japanese yen and just being dead wrong. So it's a currency pair that you don't want to fight. It's a currency pair that if you get on board, my favorite trade for Japanese yen is get a trade in, put a stop loss to break even or better, and don't touch it and see if it runs like 1,000 or more pips, because it has that potential. It's just in a once in a great while, you get these crazy, like fundamentally driven and technically driven trades. And that's that dollar yen 140 handle. If we break 140, I think we drop aggressively to 120. And I would love to be on top of that run for, a couple standard lots and make, I mean, look, one standard lot makes me 20 grand. A couple standard lots, I get 40 grand. All I have to do is get to break even, man. They could drop, 300, 400, 500 pips and never come back.
I'm not really sure what with all the way the world is right now, what bull case there would be for US. Like, when is the Japanese yen going to get devalued or go down? Like, when is it going to go? Could this chart go up? I don't really see a scenario where it goes up significantly. I don't know. Is there?
Oh, no, it totally can, because on the piggyback of the Fed cutting, the Bank of Japan can say something radical and just completely keep this like carry trade alive and well. They do that stuff all the time. They piggyback off of the Fed, where it's like Wednesday's FOMC, Thursday night is Bank of Japan, and you have like these hundreds of pips moves overnight. And it's like, if it's a fundamental shift, I'm telling you, like it is the wildest stuff that I've seen in trading, where it's like, it doesn't make any sense. It's all fundamentally driven. And if you're on the wrong side of that trade, you will pay the ultimate price by just losing everything if you're over leveraged. So I honestly, I've told traders for a long time and teaching currencies and stuff, I'm like, I probably made more money by never testing my fate with the yen. Just stay out of the yen pairs and you'll thank yourself for it later, and just trade the technicals and the efficiencies of all the other currency pairs. But it's so tempting because I see a trade like this, and I'm telling you guys, like, I wouldn't be surprised to see a head and shoulders come to fruition, and this thing goes from a 160 high to a 140 low. We break that 140 low, we go down 2,000 pips, we measure it out. It's very forecasted. but it's how we get there, and it's how long it takes to get there, and it's how it moves when it gets there. It's a nightmare. It's never easy. It's never
Well,
easy.
can you trade the FXY and
That's
be
what
safer?
I have that, Geoff. I own FXY for that
Okay.
exact reason. Yep. Because that way I don't have to deal with positive or negative swap. I just own shares of FXY. And if we see that deleveraging, then FXY probably goes up by 10, 15, 20%.
Exactly.
So that's a good hedge for me. I would trade 6J a lot more, which is Japanese yen futures.
Right.
I would trade 6J more, but the contracts only go out like 6 to 12 months, and I want to be out longer. I'd love to do like a 2-3 year dated futures contract, but I just can't get the duration.
Right.
Yep.
I'll agree with that.
Yep.
So okay. Yeah, I was thinking though FXY might be a great play if we're going to be seeing that.
It is. Guess where I own it? At the lows.
Yeah, of course.
I own it around like 59. It's like 58, 59 bucks. So
wow.
I've been in it for a while. Yeah.
Yeah. Yeah.
Okay.
So, yeah, you were asking earlier about levels in the S&P. I was actually looking at on a shorter term basis at 6240.
Okay.
If we start getting below that, I'm going to get worried about this market.
Yep.
And I think on the SPX,
What timeline are you guys thinking of for that? Like what?
I think through October. We have to stay
Yeah.
above. I think through October we can't do a lot of damage to this bull market.
right. I'll agree with that.
Yep.
Yeah, I was looking at it. Well, another thing that we're running into come Monday, we got rollover in the index futures, and we got
Yep.
a 55-point markup basically in the S&P. So that 6240 is going to be a long ways back when
sure.
we roll that contract over. So I might have to readjust that a little bit. But right now I'm kind of watching that 6240 area just to make sure. I mean, we bust that, I think we're going to go back down to your 6,000, maybe even fill that gap down there. So
yeah, I can see that. I can see it. I'm just, the dumb part is like how dramatic the headlines are going to be.
right.
I mean, are we really? And here's what everyone's worried about. Everyone's worried about a full-on, all-in recession. If it's a transitional recession where it's like, we feel it in tech and tech deleverages, but utilities and energy and non-correlated assets perform just fine, there's going to be sectors and pockets that are okay. There's going to be a rotation away from Mag 7, away from tech, into other stuff that's going to be fine. Like the market doesn't just leave the market. Money doesn't just leave the market. It just rotates. So, I mean, I thought 2025 was a good taste of the great rotation, because when we started out with the Mag 7 dropping, I mean, Mags was down 30+% from peak to trough from the February to April correction, but it's right back to all-time highs again. So we can't get away from Mag 7 right now, and it's still a very toppy, concentrated market. But I think I don't know. I think if markets get more defensive, if the consumer stops spending, if people just aren't really believing the hype, if CapEx spending stops or stalls, or all of a sudden you realize like forward guidance is you're spending all this money, but AI returns are not as good as they're going to be promised, you're going to see adjustment in earnings. And that's what we never can really time. It's like the market's always forward thinking. What is the catalyst that might change earnings expectations? I mean, one thing that might be this little like in the background is, what if the Supreme Court changes the ruling on tariffs and says you have to go through Congress? We could potentially get back 50% of the revenue we pulled in for the last 4 or 5 months in tariffs.
Yeah, I don't really know what the market would think about that. On the surface, I suppose it would be bullish, because then all the forward guidances would be increased.
I mean, it should create like more globalization, but the problem is all of a sudden the U.S. looks like we're not going to have nearly the revenue that we were promising ourselves.
Right. I think that would hurt.
I think it'd hurt the U.S. and help all the non-U.S. trades.
Right.
Yeah. So that'd be like everything ex-U.S. would be like the MSCI ex-U.S. Everything Eurozone, any ETF that's just international, emerging markets, anything that would be non-U.S. I think would probably continue to outperform.
Right.
Yeah.
Yeah, short term, I wonder. So we've been talking about this, Geoff, is like the differences in SPX and Q, or SPY, but SPX, whatever. Same thing, basically. And QQQ. So down a little bit on SPY, but today QQQ is up a little bit. So just for short term, tomorrow, does this mean we're up? I wonder if there's any correlative insight there.
Well, I mean, this morning, if you were kind of looking at things, it's a Monday for starters.
Yeah.
But you had everybody trying to jump on the tech wagon, and yet the S&P, the Dow, and the Russell were selling off. So that was kind of a warning sign right there, thinking, I don't know if this thing's got the gumption to really get moving. And so I kind of left it alone this morning. I had the inkling to buy the QQQ, but I was just like, with nobody else helping it out, I just can't do it. So I just kind of left it alone and thought, well, I'll just trade gold today, and that'll pay me something, and it did. So,
Yeah.
but
Yeah, I bet.
When in doubt, just buy more gold.
that's
Yeah.
right. That's
Yeah.
right. So, it's kind of interesting. I mean, you look at, those metals markets and stuff like that. I mean, copper really hadn't moved any today, and it's back below 460. It keeps, I mean, just like silver at, 42, copper at 460, it keeps running up there and it keeps pulling back, and it just won't get above that 460. I think if
Yeah.
we get both of those above there, uh, gold's probably just gonna go to, 4,000. I mean, I don't know. It just wants to go for whatever reason, but it really needs some help, especially out of silver, to do it.
Interesting. Yeah. Very, very interesting. Meanwhile, that Rio put's not looking good that we sold
Mhm.
a couple weeks
Yep.
ago.
It's really good, really good.
So okay, so let's run through. What's the game plan up until the 17th? Defensive trades, going long on trades,
Wide margins for
besides
error.
gold.
Wide margins for error for me.
Yeah.
So yeah, I'm positioning like I got a pretty good trade today for my waterfall income where we pulled in 70 cents and the market can drop 15% before we're taking any risk.
Mhm.
So I'm okay with trades like that. I'm okay waiting for dips. I'm okay, testing the waters of a 5% correction, maybe a 5 to 10% correction, and seeing if the market is just going to be a seasonal correction down through like September, October, and then we try to finish a Q4 at good gains. I am like actually worried about like what does the market think about these jobs? Does the market actually care? Does the market care about stagflation? Does the market, I mean, maybe it does, maybe it doesn't. That's the weird part is this market has shrugged off so many things this entire year after we got through Liberation Day that we've talked about this, guys. I don't know if the market actually cares about much until there's like an extreme policy change. If we see the Supreme Court change the policy on tariffs, that's probably not good for the US. If we see Donald Trump and company lose the midterms in 2026, they probably care about the pendulum swinging the other way. So those are the only big things I see that would really derail the US. Because also, if the US is struggling, the whole world will struggle too. It's like we don't just have, the whole world rips to bullish all-time highs while the US is just dropping. So I think the US, if anything, maybe it's lackluster performance while the world outperforms. But we can't have the US go down, 10% and the whole world's like unaffected. That usually doesn't happen. So I'm just cautious, man. I think that at the very least, we get this little ventilation out of the way. We get a little correction out of the way. And I want to position for, I'm still bullish. I'm still bullish right now. I think there's enough fiscal policy right now. There's going to be a complete overhaul in the Fed. I mean, basically like Jerome Powell is on borrowed time. The Fed is clearly stepping in line with rate cuts coming in the next year and a half. The Fed's going to be, I mean, they're not political, but you can clearly see like the timing of this is they're going to start cutting rates. And everyone says they've already misstepped and miscalculated policy. They're already too late, but they're going to start cutting rates. I think the dumbest thing the Fed can do is start cutting rates more aggressively. Don't cut by 50, don't cut by 100, just cut 25, just stay consistent. I think that's a better thing for the market to be steady as opposed to they come out swinging with 50, 75. I think that's what shakes the yields market. I think that's what shakes the bond markets. And I think that's where volatility is going to be really aggressive. So,
well, did you see the Fed watch tool when the jobs numbers came out?
It was up to like 96%, wasn't it?
Well, hold on. It dropped on the quarter point down to
but yeah,
0.88.
the 50 basis points popped
And the
up.
50 basis point popped up. And
Yeah,
I was
I
just
saw
like,
that.
oh,
Yep,
come
I
on.
saw
They're
that.
not going to do that.
They're not going to do it. They won't. They won't do it. I know.
Oh, but yeah, I looked at that and I kind of laughed. I was just like, well, somebody's wanting to be aggressive. That's
So-
not going to happen.
Yep.
Yeah, so depending on where, I mean, so how often in a bull market does like an 8% correction happen? Because that's what it would be like. Basically, we sold down to that 60-30, 6,000 level, 8 to 9% correction. And I don't know the stats for this. I'm curious. But that's a pretty, if we're saying that maybe, maybe the stocks will drop to 6,000 SPX, that's a pretty significant drop
It is.
inside of a bull market.
Well, I mean,
Yeah.
you think about this. If you remove pandemic, okay, it doesn't exist. If you
Yeah.
remove that out of the market, we're still in a bull market from back in 2009,
2009. Yeah.
2010. Yeah.
Yeah.
We're still in a bull market if you just take pandemic out of it.
Yeah.
So I mean, eventually this bull is, going to have to be put out to pasture for a little while. And
But if you say remove COVID, you also have to remove 2025 because the price action played out the same way.
Well, what
well,
about
yeah.
2023? Wasn't that a bear market?
So
2022 is a bear market. That was a 9-month
2022?
bear market. Yeah, 2023 was just a little ventilation through August, September, October. The market dropped about 8 to 10%. That was it.
Yeah.
I was going to use a stat. So I think a 10% correction happens like every 1 to 1.5 years. So we've had plenty of those. We've had, and this is what's insane. We've had 7 corrections of 20+% in the last 12 years. 7. So
The latest
we're
one was
batting
in
like every
Liberation
2
Day.
years. Every 2 years we have like a 20% dip. It's like, my gosh, that's so extreme.
Yeah.
But having the market be down peak to trough 20%, rallying up 30+%, dipping another 5 to 10 isn't that big of a deal. But I think, like Geof said, I mean, there's some key levels we need to make sure the market doesn't really want to breach, because if we're breaching 6,000, I'm concerned. We breach 5,750. I hate to say it, but nothing looks good at that point. Yeah, like we're not looking good if we give back like half of the gains we've had since April.
Yeah,
I would put this whole bull market on check if we take below like 5,700.
Yeah, and we really are, man. This has been the most boring. I mean, we've gotten used to some non-boring action on SPY or SPX. It's been boring for a while. We just really just don't want to hit over this 6,500 level, you know?
Well, there's a big call wall at 6,500. The JPM collar trade that's always really popular every quarter is heavy amounts of gamma at 65. I could see us not getting there. That's usually a hard like resistance level. So the call wall is 65. The put wall is like, I think the put wall is like 58 or 59. So there's like, that's the big range that I could see. On the extreme side, we probably don't go above 65. We don't go below 59. And then I'm curious, like once we get into October 1st, what's the new JPM collar?
Yeah.
Right. Because maybe the high side is like 67, maybe the low side is 61 or 62. And the market just continues to do what the market does best, which is still be range bound. But right now, like just at these current highs, we're still sniffing almost 10% of the S&P. We're sniffing 10+% of the NASDAQ. That's a heck of a run when you think about 20+% 2024, 20+% 2023. If we can edge out a 10+% gain this year, like that is a fantastic run. And I just think that we clearly know how manipulated these markets are. The Fed has pretty much made it its MO to basically say there's no such thing as a recession, folks. We're gonna prevent it. And it wasn't the Fed this year, but it was Trump. Trump this year like stepped in with the Trump put and pivoted a complete agenda into the opposite agenda. We went from austerity and cutting to like grow. Very different.
Alex, RSP that.
Yep.
Yeah, equal weight. Yeah, we're barely at all-time highs in RSP.
Yeah.
Yeah.
It's a thin rally.
Yeah. And but I'm not a bear looking at that though. I'm not a bear, because if we break those highs, it's a broader market that can continue to be okay. It's a rotation that we need. So it's okay. But like I said, what we haven't experienced was 2022 really shouldn't have been a bear market for equities. It should have been a bond bear market. That was really the breaking point, was 2022 in the bond market. However, we were already over leveraged and it became the deleveraging because rates were being raised. That's when the Fed raised rates all through 2022. And it was, the S&P peaked in, I think the NASDAQ peaked in November 2021, and the S&P peaked January 2022. So we peaked as the market was deleveraging in tech, but the bond market was already in a garbage bear market, which it still is. So anyway, I just think that the tools exist to try to avoid a recession. And it's like, we never want a real recession with everything down. What we have is like, well, this sector is a little struggly, put money elsewhere, rotate it elsewhere. We'll be fine. But it's just been like since 2008, 2009, it's like, we never want to have a recession. So what are the tools to prevent it? The Fed, monetary policy. Now we have fiscal policy dominance.
Well, the one thing I always look at, I mean, you think about, the Dow 30, those are in the S&P 500. The NASDAQ 100 is basically in the S&P 500.
Yep.
And if the S&P 500 is making new all-time highs, I get worried when the NASDAQ and the Dow aren't,
True.
because they ought to be.
Yeah, that's true.
And so when, I mean, just here over the past couple weeks, Alex and I have been kind of noticing this. S&P made a high, the NASDAQ didn't. They pulled back. And, I mean,
Yep.
it keeps doing that. It's just like the NASDAQ goes, nope, not yet, not yet, not yet.
Yeah.
So until that NASDAQ takes out, that QQQ takes out its highs, no, I think the SPY is going to have a real difficult time moving. And I think
Yeah.
that's what it's doing at this 6,500. Is just like, I just can't do it right now. Help me out. And
Yep.
that's the complaint. And so but I mean, look at where the highs were made, in the NASDAQ. What was that, 2-3 weeks ago?
Yeah.
And we still hadn't taken that out.
Yep.
And
And the Dow, I mean, I think
yeah,
the DIA looks like a rising wedge. I think that the SPX
look at
looks
that
like a
thing.
rising wedge. You know, the
Yeah.
Qs, the Qs have rolled over a little bit, or it's just sideways. I think we just have like, up, down, sideways for a little bit of a range. But I see a rising wedge, and that's usually, and a rising wedge is not a bad pattern. That's usually just an inevitable corrective pattern, but it doesn't mean that there's more to the top. A rising wedge is just like, we got overextended. It's time to pull back. But I mean, if you look at some of the moving averages that Alex has on this chart, I mean, I would happily position for some dips in some of those moving averages. I plan on selling some options. I plan on doing some debit spread nibbles. And if we get down to like 435 or 430 Dow, I'll take a bite there. I mean, that's not a huge
Right.
correction. That's
Nope.
a, 5% correction. Usually
Yeah.
the volatility in the Dow is way better. Dow could be down 5%, and maybe the S&P and Qs are down 8 to 10%. But I take a stab at the Dow,
Sure.
So just get a correction out of the way. And I think that's this window is, we're struggling to break any higher highs. We're clearly dealing with some rough data right now. Inflation's, I mean, and what's funny is what's the best way to battle inflation, guys?
Growth.
Own assets and grow. Yep. So like
Mm.
the idea of like, well, the market's going to sell out because of high inflation. It probably won't.
No,
If anything, it's
no.
like the market might dip because of bad news initially, but that's the reaction. But the long term is we've got to find ways to have assets that can at least keep pace or outgrow inflation.
Well, that's what I've said for a while, is like, your dollar's losing value every day. There's what you have to figure out. To me, equities have become almost a stand-in for the dollar to, keep pace
Absolutely.
of inflation.
Yeah.
So that's why, like, the economy can suck. I still think the markets are going to go up because people are still going to be trying to like maintain their head above water,
Right.
as their purchasing power decreases. So, yeah.
Well, but it makes it even worse that people aren't participating. That's the hardest part to think about, is how many people aren't, like, the 30 to 40% of households that aren't participating, how much further and further they're getting behind. That's the sad part.
Right.
And they don't really have any, they don't have a soapbox to stand on. They don't have a way to fight back unless they vote differently. And that is what I'm saying. Like, the big policy shift could be the pendulum in 2026. If they're like, you know what, this economy isn't working for me. I'm working more. I'm getting paid less. I'm losing purchasing power. Life is more expensive. I need help. And so, like, that demographic is not going to vote for this administration. They want something different. And I'm not saying it's right. I'm not saying it's good to swing the pendulum the other way and be one extreme to the next. But if you want more handouts, Trump's not your guy. The Republicans are not your party. That they're handouts for the wealthy, not the poor. So
I'm just looking at these charts, man. Like DHI, Rocket, probably Leonard too, right? I mean,
yeah. Well, Lennar, Toll Brothers. Yeah, I just heard that Buffett just started taking some positions with Berkshire in, like, I think it was Lennar D.R. Horton. He started buying some home builders.
yeah. So is that why they're popping partially? But also
partially, yes,
rate
and
cuts,
also
or rate drops rather, or
I just don't want.
upcoming
I don't want to participate in these. They've already run so much.
I
If you
know,
go,
I
so
know.
PHM is one, Alex.
Is that
I mean, I've been in Pulte since. I mean,
Pulte?
I bought a home first with Pulte when it was. This is embarrassing. I bought this thing back in the 40s, man. I bought Pulte at 40 bucks a share, and it's up to 141.
is that the HUD secretary? Because I know his name is Pulte. Is he the?
I don't know if it's the same guy or not.
It's
It wouldn't
a weird
surprise me.
coincidence, though, right?
I know it is. It wouldn't surprise me.
Yeah.
Yeah.
Wow. Yeah, you got to know. Good while ago.
So it was what is that? Builder Source BLDR.
BLDR.
B.
Builders First Source.
Yeah, that's it.
Yeah.
I know they've been.
Well, I mean, vis-a-vis the other ones, they kind of have a better entry point, I guess.
Would that be, well, but is that like a Lowe's and Home Depot? That's like home
Yeah.
improvement chains. That's like is that a bunch of stores like let's see here. Construction services, professional home builders, subcontractors, remodelers. I mean, it's not bad. Well, that's like DIY projects / adding home renovation stuff.
Exactly.
That's not bad, but people have to have excess cash to do that. And right now, paying a subcontractor, general contractor to do any housework, I don't know. It's like freakish how expensive things are. Having
Oh,
somebody
yeah.
come and look at your house or do a basic assessment. I mean, I had a buddy that had his kitchen remodeled. He's doing like they're pulling out some tile, putting in some life-proof flooring, changing out some cabinets. $65,000 for maybe
Really?
a week
Wow.
project, and I'm like, dude, I would never pay. He's
Bro,
like, that's the cheapest quote we got.
dude.
I'm telling you, dude, I play golf with a guy that installs windows that makes like $300K a year.
Yeah.
Never went to college. And again, nothing wrong with that, but I'm like, the trades are killing it right now, and it's an incredible position to be in because people that don't have the skills to do that stuff will pay what they know they have to pay. You want to get a new roof, you want to get new house renovations, you can't do those projects. Somebody's going to quote you, and you're going to pay for it.
Same thing. My wife took her Forerunner in to get the oil and filter changed and tires rotated. It cost $140. It was over $80 in labor, and I was like, "What? $140 for an oil change?" I was like, "It's crazy."
I got a good one for you. How about getting spark plugs changed for $1,500?
Oh,
I said, I'll do that myself, guys.
Yeah,
I can do that myself.
Oh,
$1,500. Devanshi is asking, is Builder going to run up next? Well, I wish I knew.
Well, think about the home market for a second. I think the reason that LEN, TOL, PHM, is it DHI? Those are all the big home builders.
Yeah.
I think the reasons those are running is because rates look to be coming down, and at the very least, supply needs to catch up still. There's not enough homes available. So again, if these builders, and this is like good in the, I'd say, short term and medium term, these guys just go on a crazy building spree and they build all these homes, but yet let's say that rates don't really change a lot, and all of a sudden it's still 6 to 7% to buy a home. People won't move out of their 4% interest rate to buy a new home unless prices come way down to buy another home. So existing home sales are getting discounted every single week. Everyone that's sitting on the market trying to sell a used home is going to have to get cheaper and cheaper and cheaper as new builds are going in with an excess supply that I think we're ultimately going to have a supply glut. So I think these are good to get the run up, but I would not want to hold these longer term, because if all of a sudden you've got, millions and millions of great homes that are available to buy new, but nobody's buying them, I think that's a problem.
Yeah. I mean, versus I would say Builder has, it's less of a run up than DHI and Lennar. So maybe underlying might be good. I don't have a
let me look fundamentally. I'll take a quick. So BLDR,
the options are super expensive though. So
are they? Okay.
No options. I mean, you're paying $1,000 or nearly $750 to $1,000 for.
Okay, price to sales. So we got.
But another thing you have to think about with the new homes, they're going to be a whole lot more expensive. I mean, look at the price of copper. I mean, you're talking,
dude, nothing's cheap, man. Like, there's no way they're going to build. There's no way they're building these homes for cheap. There's no way.
Zero. I mean, you can't do it. So, I mean, I don't know how people are going to have the money to go out and buy a new home.
I don't think you will. I think that unless rates come down dramatically, because I know that a lot of people. I did this too. I sold a home in Michigan, and I bought a new home that was like 1,500 square foot more, and paid literally like $50 different in my mortgage price. So a lot of people during COVID with refi and with moving bought more house, more bang for your buck with lower rates. So if rates aren't going to come down, house prices have to come down. Rates maybe change the housing market for the better, but house prices are probably not coming down. It's stuff, like you just said, Geof, stuff is so much more expensive. Supply is more expensive. Labor is more expensive. Yeah. How on earth are you going to have the same home? And I know this, like, I'll just speak Michigan market here. The homes from Pulte, for example, or Atoll or Lennar, or whatever, DR Horton, those are all builder grade for a 3-bedroom, 2.5 home, those should all be like anywhere between $350,000 and $500,000. All of them. They're like, that's the window of like, that's what they build. That's the quality that you're getting.
What they're worth.
That's what
actually.
they're worth. But they're being sold for 6 and change, 7 and change, 8 and change, because the land, the lot, all the stuff they attach to it, all the upgrades you can put in at the design center. Those homes are being listed on the market for like $650,000 to $700,000. Homes in Utah that are literally those builder grade homes are $800,000+. It's not worth that much money.
Yeah.
You know?
Yeah.
So it's just, and I'll honestly, like BLDR, looked at the fair market value. It's not something I would trade for the run up. I don't like that the other builders have run up already. I personally don't love those trades at all. I did participate in PHM, and I did a lot of home builder stuff back in like COVID. But since then I'm like, I missed opportunity for buy and hold, but mostly I traded options thinking like they'll go up in stock because we need more homes. And they've made a good run. I mean, they're 2 to 3x what they were, but now it's like, okay, so it's a good run up to maybe get ahead of this like supply glut they're going to build themselves into, and then they're going to crash when they don't sell any homes. They'll have homes on the market that don't sell, and it's going to be like maybe a minor housing crash or minor housing bubble. So I don't know, man. And it sounds like so doom and gloom. It sucks because it's really not. It doesn't have to be that way. But I don't know how. It's not a crisis when most people that are sitting in homes can still afford to be in their home. Most people that are still getting by, it's because they have a ton of household equity. Where the real bad shift happens is if house prices come down across the board and people have to sell their home for less. And if rates don't come down, people can't afford to buy anything new. That's, I think, ultimately where we have a freeze, not necessarily a crash. So I think if people are smart, you just stay put. If people can, figure out how to like live within their means and stretch things out a little bit longer, then maybe things get better. But to just assume that like prices are going to get cheaper, it's like, that's not good. If you mess with people's equity in their homes and you mess with people's portfolios, people get really pissed really fast. And that's when risk off really happens. So
you're just saying buy Google and buy gold and we're good.
I mean, Google on dip, sure. Yeah.
Yeah. I mean, Google would have been good to buy a couple weeks ago for sure.
Yeah. My ratio spreads worked out just fine.
Nice.
You guys hear that enough from me? Ratio spreads. I mean, I did like the 165 by 160, the 155 by 150, the 145 by 130. Those were some nice runs that we hit all-time highs. So those are all closed out for profit. So now I wait. Now it's overbought. We're hitting all-time highs. I thought that was an outlier type move. If we're going to maintain like in the options chain, the type of runs on Google to all of a sudden go higher. I think I put in, let me check my trade here. I've got a pending order on Google. I think, Geof, didn't you and I talk about it last week?
Mm-hmm.
Yeah. So I still have a pending order, a 240 by 245 bear call spread.
Right.
It's trading for $150. I didn't get filled. I put a 350 credit in. So I'll wait. I mean, if price wants to try to tap those highs, like I'll wait. If I get filled at a great credit, I'm risking $1.50 to make 350. I'll wait. But I'm not chasing much, man.
I think.
So is Zillow, do they sell houses?
No, maybe.
The like Redfin, Zillows. I mean, I don't even know how they make money outside of like listing and ads. Maybe there's like MLS sales that come in. Maybe there's real estate sales that come in. But I mean, I'm sure they do. They probably do like a lot of the, the third party stuff where it's like, if you don't want to pay your buyer and seller fees, like you can do it through a Zillow, neutral party or something like that, maybe.
Right.
But
holy equity growth, Batman. Zillow reports U.S. home sale values hit a record $55 trillion, up $20 trillion since early 2020.
That doesn't mean anything. That's all funny money.
It's crazy.
It's like
until you sell, it's all on paper, right?
Exactly. It's paper money until it's like, what can you get out of it? Like my brother right now, this is an interesting market. My brother has a home in central Indiana that I think he and his wife bought like 15, 16 years ago for like $200K. Right now they're trying to list it for like in the fours. I think they can get it, but it's like, dude, it's like an 1890s Victorian home. It's like 8 bedrooms. It's ridiculously big, but it is a money pit, man. And I'm wondering, what do they get for it? If they can get $400,000+ out of a town that doesn't have a lot going on,
and they break even.
Good for them. Yeah. I mean, it was $50K for geothermal. It was $25K for roof, and it was $25K for siding. It's like, they're all into that house for probably close to $300,000. So, I mean, they'll get something out of it, but it preserved value versus losing, I guess.
When you buy a house, I mean, to get insurance, they'll mandate that you have to do certain improvements to it, right? Because it's like you have to get foundations
Yep.
fixed or sewage lines fixed or
Yep.
trees out of the lines, whatever, right?
Yeah. Things has to be the code.
Yeah. So these even buying an old house, like that's not the answer necessarily, because it's going to cost you
Yeah.
maybe the same as buying
Well,
a new
the
one.
argument is there's a Netflix documentary. I don't remember what the guy's just like it's personal finance stuff. It's all about just like renting and budgeting.
Oh, Ramit. That's Ramit.
Yeah.
Yeah.
Like whatever that show. Amy wrote the book and it became a Netflix thing.
I will teach you to be rich.
There you go. But
Yeah.
he rents and I see the value in that, but it's like I don't love the idea of paying into nothing. I pay for rent. That's great to budget it, but it's like I have zero equity when I leave this place. When I move, all I did was budget. Like if I want to rent somewhere and budget myself, that's fine. But it's like if I want to have a home and have equity, I don't mind getting something back after paying something for 5, 10, 15 years. Right. But if I'm a short-term dweller, then absolutely I'd rent. If I was only going to live somewhere for a couple of years, I'd rent all the time.
Yeah.
What I've done, if I've moved into a new city, I always rent when I get there for a year. That way I can take my time finding a house. That's what we've always done.
Yeah.
I've never rent outside of that.
Agreed.
Right.
Yeah.
Yeah.
This is 3 years for me in Utah before, I decided I'd lay some roots here. So 3 years in, this was a decent market. We bought in for like 520, 525 all in for this place. And it's a brand new build. The median home price in the area is like almost 7. So like we got some room to grow into this, which is good. I mean, and again, I'm not saying I'm buying this because we expect 200K in equity, but it's like we still have like another couple of phases to finish, and the base price is already going to go up by like 50 grand. So like I think we're safe to at least have that in equity. And I'm going to try to be as aggressive as I can to make this like I just want to pay this house off. If I can pay for this house in 5 years, I'm going to try. I might not be able to, but I'll try.
Yep.
So man, look. I don't know how this all summarizes outside of like, we are in some crazy times right now. And I can't say that it's like bad because life is expensive. But if you're a trader and you're an investor and 401ks are sitting at all-time highs, like all these things can be great. But my gosh, it just seems like all it takes is one nasty headwind or one nasty hurdle that we can't get over. And we just see like all these gains that just like go away.
Well, one thing that I think is helpful just for folks to think about. So, we talk about this. I talk about this on Daily Spy trades. I use this when I trade futures. We don't talk about futures, but I use it to trade futures. Is supply and demand zones, right? So the idea of supply and demand zones is, when you're where's my little shapes? Let's say this is a supply zone.
Yep.
This is where's my shape right here? This is a demand zone, right?
Yep.
So for you to keep on going higher, right? That means that you have to have more demand pick up for X ticker, right? At this price, SPY, NVIDIA, Tesla, right? Now, try and ask yourself, you're thinking through this, what's going to be the demand instigator at this level? Now, I'm not saying
Tina. There is no alternative. That's the
that's
demand.
The only one I can
think
of right now, right? I mean, that's the only one I can. I mean, I can't really think of one that people would be like dying to get in right now, which is why I don't think we're out of a bull market. But I do think I personally think we're going to I could foresee a correction in the next like month and a half.
Do you guys track institutional flows? A lot of the podcasts I've been listening to, reading about, is that institutions are positioning heavy amounts of hedging, heavy amounts of like de-risking, de-leveraging. That doesn't necessarily shape the market or give us direction, but retail is like the only participant since the market's been melting up from what I'm gathering. So are you guys following institutional flows? Is it?
I do. I look at the NAAIM every week.
So is institutional flows, are we getting like, I could see institutions rotating versus leaving, and I could also see that passive, like portfolio managers for the most part, are probably underperforming.
Yeah.
Like, broadly speaking, financial advisors don't do anything outside of parking and mutual funds, and they're peddle their own
Yeah.
company
High
funds to
commission
participate
stuff.
in whatever.
Yeah.
Hey, the S&P's up, we're up, everybody. We're awesome. The market does
Yeah.
the great things. But
Yeah.
an active portfolio manager is probably underweight a lot of things, and either they have to catch up and add more exposure, or they're going to continue to stay underweight and just like miss out. And I don't know if they're going to be brave enough to add at these highs. I think that they might just be waiting for a buying opportunity. So this is why I'll put this in a positive spin. I think that people that are underweight and underperforming are probably salivating to get a better price to buy.
Mm-hmm.
So I
Yeah.
think there's still a dip in there somewhere, but I just don't see a lot of excess participation at these all-time highs right now. Not right now.
Mm-hmm. No, and I don't think this is doom and gloom. We're not calling for like an 08. We're not calling for like a retracement to 4,000 or whatever. Like this is like a
Yeah.
we're not like Peter Schiff. I don't think.
I mean,
but we all are buying gold, so maybe
how
we are.
grandstanding is that guy getting since gold's up?
Yeah, I know.
All that guy cares about is gold.
I know. But like look, things go up. Like it does. I mean, let's just look at Liberation Day on this chart. We don't have to move the chart. A big old dip, and now we're back at all-time highs. So, but dips happen. It's nothing to be afraid of. It's just
sure.
more buying opportunities. The question is, what we're really talking about is this trend from May to now. Does it stay here or does it go here? Right, a little bit. That's all. That's in the grand scheme of things, and that's only on this year. You go back 2 years, 3 years. I mean, look at what's happened. It's really not that any corrections. It's not going to be a well, I mean, hopefully, I can't ever say it can, but I really don't think it's going to be a world-ending, world-shattering, regime-changing event.
Cycles are faster too, right?
Right.
I mean, if we have a correction of 5 or 10%, it could be over in 30 to 60 days. If we have a cycle where the market corrects, for 6 to 10 months, 6 to 12 months, it could probably be over right after that. So, I mean, I said this in my waterfall income class. I had a live session day for trading. I did a master class today. That's one strategy that's very flexible for just the ability to participate. You just show up and you trade every week. You participate what the market's given us, right? The market could be sitting at all-time highs. If it's going to continue to make all-time highs, we're still making money. If the market's going to dip 3-5% and still rally back up, we're going to make some money. If the market dips 10%, rallies back up, we're still going to make money. Yeah. I mean, you got to give this market credit for what is accomplished in the last century. You look back, it's like, I know that the modern market is probably more 1990s to now. That's the modern market. You could even say that 2008, 9 to now is like the most modern market, but you've got electronic trading since the 90s. You got options that have been created since the 70s. I would say from 1970 to now, that's your modern market window. And now it's just like faster cycles, faster rotations, more speed, more rotations. And I mean, honestly, the holding periods are way different. If you're a hedge fund, the average hold for a hedge fund is now like under 4 weeks. It used to be like 6 to 12 months. It used to be like a year. Now it's like under a month. It's like the rotations happen way faster, and they're all together, man. I mean, when you're in, I mean, Wall Street they're working hard to make money, and whatever that is, if they're edging out, they're gonna make the retail crowd seem like idiots. But it's like Wall Street isn't permanently hedged. The Big Short happened, and look how many people made money. The people in that movie were a handful of people that made money. Wall Street got smoked. Right.
Yeah. But another thing you have to remember with the price appreciation, volatility increases because a 10% correction on a 6,500 S&P is a whole lot different than a 10% correction on a 1,500 point S&P.
Yeah.
So you're going to see a whole lot bigger swing. People see those bigger swings, just like what we had on Liberation Day over here. It's a whole lot bigger swing, but percent wise, it's still not that bad.
It's the same thing. If you looked at this market over the course of 1970s to now, as a percentage basis, we've had lots and lots of the same things happen. They go up, they go down, they go up, they go down. We have the market pull back, we have the market go up. It's like it's all the same. It's all the same. But yeah, the law of large numbers, things are huge now. You get 1,000 points in a day. Well, it's like 1% now.
Yeah.
Who cares?
Yeah.
Yep.
You have to look at the relative values,
Yep.
not the absolute.
Exactly.
Well, gentlemen, thanks. By the way, that if anybody, we talked about MBOT a couple weeks ago. We went long on the option and on the stock, and they did get approved for their little FDA endovascular robotic system. So they're popping today. So
Very
anybody
nice.
who did get in on that trade, we're up like 15% on the underlying. We already exited the option, but yeah, good job.
Great
guys.
work on that. Alex, can I grab the screen here for something?
For sure.
I want to walk some traders through. I think this will be kind of fun. Let me grab the screen here. So this is just a way to kind of think about, look, we're all trying to make some money in these markets. Okay. If you give yourself, let me just use a slightly cleaner chart here. Blank. I try not to make these charts too messy. Okay. So if we just think about the S&P, that's it. And I go back to all these weeks, the bottom of 2009 to the COVID crash, to the ventilation year in 2022, to what we saw during Liberation Day, blah, 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 blah. Okay. This is a weekly time frame. Like, let me show you a P&L just as an example. Let me find my option Omega right here. Okay. Is that a P&L you'd like to have? $100,000 turns into 1.5 million. It took a decade, but you annualize out about $125,000 a year with one trade. Okay. If you think about this market every week, and all I did was start off with a buffer of, okay, the market's here. I give myself about a 10 to 15% room for error. I start out right here, 10 to 50%, 10 to 50% over and over and over. Does the market ever really hit that 10 to 15% threshold week after week after week? And most of the time you're going to say it doesn't. And most of the time you're going to see it doesn't. So what I'm trying to get at here is there is a way to trade where we just have to show up every week like clockwork and just place a trade with a nice margin for error. It's define risk, define reward, and we just let the compounds gain and do what the market does best. If I could go back in time, guys, I would love to dollar cost average in the market at any 5, 10, 15, 20% dip. And I think all of you would like to do the same thing, because the amount of wealth that has been generated over these last 20 years has been because of these really big corrections. Look, I don't want to have a big correction. It's never fun. But you know who comes out of it? Everyone that has dry powder to participate. This year, like personally, my fund is up about 25.5% right now, which isn't bad. I'm up 25.5%. And it's only because I participated in all of the ugliness that was March and April, and I came out on the right side of it. I have been super, super passive through July and August. I've let the melt up be the melt up. I hit all-time highs again this morning. I'm happy, but I'm not satisfied. Like, I still want to trade and make more money, but I'm also very cautious. So I am proceeding with caution, right? And so if you think about, it's one of my core strategies here that allows me to trade with about a 15% buffer every single week, and I have capped risk. So the most I can lose is maybe $1,000 or $2,000. The most I can make is a couple $100 with a profit trap of maybe $500,000. It works out, but like the percentage win of like 95% winners, 97% winners. I do love that strategy. And if over the course of a decade, if I could make $100,000 a year for the next decade, I'd freaking love it. Every single year, like, sign me up.